So I'm delighted to have Professor Bob Eccles be our moderator today. As many of you know, he has written some of the most forward-thinking articles and research around materiality, ESG, investing, and corporate performance. And I always learn from him whenever I spend time with him, and it's been fun working with him on putting together this panel. So, Bob, thank you so much, and we look forward to you and the panelists' conversation.
Okay, thank you, Tansi. So on that gracious introduction, I hate to start out on kind of a sour note, but Tansi said something to you this morning that wasn't true. And so I just want to make sure that's corrected for the record, because this is being videotaped. And this is going down to posterity. She said, Bob did a terrific job organizing the investor panel. And this morning, 40% of the investor panel dropped out, okay? Just like that. So that's not such a terrific job in my view. Fortunately, some people came to the rescue. Jerry Dobson from Parnassus Investments, Megan Starr from Goldman Sachs Asset Management. I put them next to me, okay, just to make sure they don't screw this thing up. All right, they're the B team. But there's actually some logic to this. Jackie Roberts from Carlyle, head of sustainability. Charles Penner from Jana Partners. So let me see if I can help you with the dimensionality of this. One of the first socially responsible investing funds. Big mainstream $1.3 trillion asset manager. Private equity, activist hedge fund. I'm just saying. And then Amisha Parekh from Bloomberg. The whole responsibility in the end, Amisha, of this panel falls on you. Because what we heard from the corporates is that, we have, too much data, not enough information. There's all these data constraints on being able to move from correlation to causality. These people depend upon you. You're in this business. So, Amisha, if you and Bloomberg can't get this right, I'm just saying again, what do you expect these people to do? So that's kind of the context for this panel. So what I'd like to do to start is give each one of my esteemed panel members a couple of minutes to talk about their ESG investing strategy kind of through the lens of what they do. And then we'll kind of dig into the causality thing. I'll encourage them to, abuse each other like I'm abusing them and the rest of you here. And then at some point, we'll open it up to the audience and you can do the same. Jerry. Oh, and one last thing. Another reason I'm glad you're here. You're old. You're older than me. That made my day. 2 panel members drop out. I'm feeling bad about myself, and there's somebody here older than me. So, you get a lot of credit for that, Jerry. I appreciate that.
You're welcome. Parnassus was started in the early 80s. It emerged out of like a lot of the format this in the 70s and social responsibility. And when I started, it was started actually in 83, and then we actually opened up for business in 84. The idea was that we would get good returns. It was a very difficult environment, much different than today, because people said, well, if you take social and other factors into account, environmental factors, you're doomed to underperform. And Forbes wrote very negative articles on us. We had other articles very crushing and negative. And they said it's just not going to work. And I didn't agree with this, but I didn't know. I don't really have a track record. We're starting out. I'm trying to get money in. And so what my thought was, first of all, one half of it was Graham and Dodd. And basically, a lot of you probably read The Intelligent Investor. And that made sense. What Benjamin Graham was saying, he says, well, what you should do is look for companies that have the stock prices dropped. It's a temporary phenomenon. If they're going to come back. So I said, hey, that makes a lot of sense to me. I was a bargain hunter. I came from a relatively modest family, so didn't have much money. So I had to look for bargains. So this fit right in my philosophy. The second part is I said, if you invest in companies that treat their employees well, that have a good environmental policy, that are generous with charitable contributions, they should do well as businesses. And of course, the prevailing opinion was very much the contrary. And what I found out is it actually worked, but it took a long time, and today people seem to agree to that. I mean, a lot of it is common sense. We talked earlier that if you're environmentally responsible, number one, you should use less resources, right? Shouldn't that be part of the thing? Number two, you shouldn't be liable to lawsuits. You shouldn't be liable to fines. It makes a lot of sense. And the same thing with treating employees. If you're treating employees well, then they should perform better, and it should make sense. And to me, it was common sense, but for some reason, it was not the prevailing opinion. The climate opinion changes so radically over time. So that's what really started off. And as time went on, Parnassus had a great performance track record. And right now, the fund I manage, Parnassus Endeavor, is #1 in its category. It's beaten the S&P by 5% per year over the last 12 years. And those of you who know the finance know that 75% of the mutual funds don't equal the S&P. So we have a great record. Part of it's because of the value orient, the Warren Buffett, the Benjamin Graham type idea, but a lot of it is because of the ESG aspect. And I'm not saying which is more important. They're both very important, but that's the history of Parnassus. And I think that exhausts my 2 minutes.
That's great. Thanks. Megan?
Well, my history starts slightly more recently. So I work at Goldman Sachs Asset Management. I'm part of our ESG and impact investing team. And we really started in earnest about 3 or 4 years ago, in large part because of the sea change we were seeing across our investor base. You know, this went from something that was popping up every once in a while to all of a sudden the largest public pension plans we work with were saying things like, we're long-term holders of assets. So we think things like climate change are material risk to our portfolio. Can you help us think through that? And so I think we just saw this shift from what had been kind of a morals-based or a philosophical question very much become an investing question. Where are these factors material? How do I think about them? With the same rigor or diligence I would bring to any investing question, like portfolio construction or risk management. So in 2015, we ended up making an acquisition. We acquired Imprint Capital, which was one of the largest dedicated ESG and impact investing advisory shops in the country. They like to refer to it as a merger, so we merged with Imprint Capital. And so now we have about 30 people full-time working on ESG and impact investing across the investment management division, which I don't think is an interesting data point in and of itself, but I think is indicative of where we see this going in terms of becoming kind of central to how you think about mitigating risks and capitalizing on potential upside opportunities in portfolios. And so we have some we have some distinct opinions about different tools and where it's important to think about the kind of materiality and causality of ESG factors versus where sometimes investors just want to use them to optimize a portfolio to track a given benchmark. And so where they're being used for outperformance versus where they're being used to kind of passively align portfolios.
Great. Thanks. Jackie?
Is this one on too? So I came to Carlyle about 4 years ago as the first chief sustainability officer they'd had. And it was a point in time when they had for about 4 or 5 years, they'd had a responsible investment policy. They had a process to make sure every deal kind of checked on these issues. But the goal was to actually start to do environmental and social risk assessment, and then also start to look at value creation opportunities in a more systematic way and with some expertise. So they talked to me, I was at Environmental Defense Fund, about coming in-house as a resource to the deal teams, to the portfolio companies, and to our investors. We don't have an impact fund. This is all with our traditional investments. But I would say the 3 areas that I spend the most time on are making sure that in due diligence, our teams are getting smarter about what are the impact of environmental and social and governance issues on the businesses they're looking at buying. Do they understand the issues? SASB's been a great tool for us to be very systematic about that. I'll, on certain times, just get engaged in lots of conversations with the deal teams about how to think about a particular issue. But due diligence is a big part of this role. Ownership, as you can imagine, when we invest in a company, and we'll hold a company for about 5 years, some come incredibly mature on how they manage and think about environmental and social issues and how they intersect with their business. Some are maybe fast-growing founder-owned companies that really have no systems in place. They're very small, but suddenly they're selling to Walmart and being scored on sustainability and trying to figure out what to do about that. So that's a company I worked a lot with. So in the ownership phase, it really, one size doesn't fit all. I would say the most important thing that we're really trying to do right now with our companies in ownership is help them be strategic. And by that, I mean understanding what stakeholders they really think care about environmental and social issues, articulate that internally, try and measure what impact they're having, try and be clear on, are we doing this because employee engagement is a benefit? Are we doing this because competitors are ahead of us and we got to keep up, or we want to stay ahead of competitors? Are we doing it because we're hearing back from customers about different aspects? But be clear on why you're doing a set of initiatives and be strategic about it and use that to start to build value in kind of a broad sense. And then Carlyle ourselves, our impact, our primary material issue really is our investment process. But we also have a carbon footprint. We also play a role in trying to bring gender and racial diversity to the financial community. So those are areas where other colleagues of mine have certainly worked on diversity and inclusion, but those are areas where, at least in our own thinking about what is our own ESG strategy, those are important areas, and we track those, and then philanthropic giving is also part of our employee engagement strategy. So those are the different areas that I intersect with, and every day is different because it all depends on what company and what sector we're looking at that particular time. So.
Thank you. Charlie Penner from Jana Partners. As Bob mentioned, we're kind of moving backwards through the evolutionary scale to reach the primordial soup. We're a traditional activist shareholder, but we just launched, or we're in the process of launching, an ESG impact fund. And, we're obviously, starting a new initiative here, but the basic thinking behind it was that as a traditional shareholder activists, we have always focused on events in kind of the near term. We would argue that they create value over both the short term and the long term, but they still have been near term corporate events like CEO change or board change, recapitalizing the company, restructuring the company, things like that. And as part of that, there's obviously an ongoing debate about, if people are properly focused on the short term versus the long term and things like that. And just the realization that led us to launch this initiative is that a lot of the things that people would view as, at least in our world, as being beyond the kind of purview of the traditional shareholder and more the focus of the supposed long-term ESG crowd, as the world gets to be a more and more complicated place, are having much more of a material impact on current valuations. So the obvious one is climate change, and I'm sure everyone saw the panel earlier where Mars Corporation is spending all this money on reducing their carbon footprint. Another one's income inequality, where retailers like Walmart are saying it's not a great thing if we have so many of our workers on government benefits, and by raising wages they saw the benefits of that. The one that we flagged a few months ago was in the technological change space, where we challenged Apple to improve the parental controls for parents, and they've responded really positively. So it's a new thing. It may not work, but we're excited to try it.
Last but not least.
Not least at all.
Amisha Parekh. I'm fairly new to Bloomberg, but I'll start with our journey, similar to kind of Jerry's story, which I think if you look at Bloomberg, where it started was Mike's belief that transparency leads to better performance and better capital allocation decisions. And you take that same concept applied to sustainability. That's really where Bloomberg is focused on from a sustainability perspective. The two areas where Mike is really taking a leadership role is Sustainable Accounting Standards Board, which is really taking a sector view, for those who aren't familiar with it, taking a sector lens to say, what are the issues that are material? Rather than thinking about all environmental, social issues that a company may want to be involved in, what is financially material from an investor perspective? The second area we're highly engaged in is the Task Force for Climate-Related Financial Disclosures. This is a significant risk in the market, and we need disclosures to help investors make the right choices. And if you look at what that means, how that translates into a product, our entire strategy is built on make the raw underlying data available so that investors can make these choices. And so far, I think for the investors who use our data, they've been locked in on the terminal. Finally, we have permission to launch our environmental, social, and governance data as an enterprise data feed. And what that really means is for folks that are looking to find correlations, try to do really heavier analysis, this is now available, and you can make these choices. Because what we believe is connecting where this corporate reporting is happening in a way that's material to our investors. So I think there is a role we play, and most of my work involves thinking about how do you make that data better and more accessible.
So thank you all. Let me just a couple themes, and then we're going to dig into this question up here. Jerry, you're right. I mean, when you started this, back in the Jurassic period, something like that, a while ago, roaming with the dinosaurs. There was the belief, right, that any kind of socially responsible investing, you were giving up returns. I think some of that's a language thing. If you notice how many times people use the word materiality on this panel, on the corporate panel, we'll come back to that. That's changing. I did a survey of 582 institutional investors with State Street last year, half asset owners, half asset managers. And one of the questions was, do you think you give up returns? And 48% said no. They don't think that's true anymore. 35% still said yes. Okay, so there's 35% that said yes, and then 17%, they're still thinking about it, right? They didn't have an opinion. The correlation and causation. I'm glad that Tansi's doing this conference. So if you look at the academic literature, there was a study that I did with a guy named George Serafine 5 or 6 years ago, 90 high sustainability, 90 low sustainability companies. The high sustainability companies outperformed stock returns, accounting returns, and their behavior was very different. We don't have time to get into that. People said it's correlation, not causation. Then George did another paper, beautiful paper, seminal paper, using SASB's materiality guidance, looked at portfolios, companies performing well on the material issues, outperformed companies performing poorly on the material issues. Limited subset, industry specific. Companies that were doing well on the immaterial issues were doing a little bit worse. So there was a link there. Again, it was correlation, not causation. And the most recent study, and Doug is going to talk about this tomorrow, was done by the Boston Consulting Group called Total Societal Impact. And they dug a little bit deeper into 4 industries. So they were able to get down and say, for these very specific issues, here's the percentage impact on gross margins, on valuation, but it's still basically correlation. It's not causation. Now, this is really important for you folks because you're like investing money, and a lot of money. In your case, $1.3 trillion, you're what, 26?
We're only 26 billion, but that
26 billion.
That's still enough.
26 billion,
Spare change.
Jerry, give me a break. So it matters to you, but where do you get the data? Because the other thing that this survey showed was that the biggest barrier to ESG investing was lack of data. And when I was sitting here listening to Tansi's presentation this morning, I thought it was fabulous, but look at all the data that they had to dig into. And then look at the corporate panel, and they talked about the data they got into. The only person on this panel that would have anything close to the data that the corporates would have or that Tansi has access to would be you, Jackie, in a private equity concept. So let me start with you and say, to what extent, in your due diligence process and your investment decisions, have you been able to look at these causal relationships between the ESG factors and financial performance and put kind of weights on them? Can you do that yet?
Well, one thing I will say is it has been pretty rare, fairly rarely that we actually see the data I would want to see in the data room. So does anybody know what the expression data room means? So if you're in the private equity world, often you're bidding with other people on a company and you're given a set of data that you can use to prepare your bid. And there's a certain number of chits, really, you have to go back to the company and say, could you tell us a little more about this, or could you give us a little more information there? And depending on how competitive that process is and how much leverage you have, you either get to ask for more information or you're pretty reticent about what you ask for. And rarely does ESG rise to the top of, I'm going to go back and ask for that data before I bid. And so a lot of times you really have to make decisions about if we were to find X, or let's assume X is weak, as it generally is for the sector, what would it cost us to fix it? And you have to have a sense of that, so when you're putting your bid together, you know what you might need to invest. So there, the data really isn't there yet. Once, as a private equity firm, we own a company,
Right.
we can then start requesting that they produce information. And so we're starting that process. And again, even in that context, we found that the CSB standards are very helpful because although they're risk-focused, when you sit down with a company and you start walking through them, they'll say, you know, we already tracked 3 of these 8 metrics, and customers are actually asking for these next 3 anyway, so we really need to start doing those. And 2 aren't relevant to my company because either it's this or something like that. But we found that the CSB standards are very helpful for those conversations with companies as well. So that's how we begin to see what's happening on the ground. And I'll tell you the most interesting part about that has been we are seeing opportunities for creating value that the companies aren't putting together. And by what I mean, we'll see that they've had a big success on a particular metric, and yet marketing knows nothing about it, HR and recruiting knows nothing about it. They're not using it when they're going out and trying to get corporate accounts. And so we're trying to help them see how to take some of these initiatives and progress they're making and be strategic about which stakeholders might care and use that to create value.
Let me ask you a follow-up question real quick. So in the corporate panel, Jim Sullivan from SAP talked about how a 1% increase in the business culture health index was like 90 million euros, whatever it was. And you see that on their website. I don't know if you're still here, but big shout out to SAP for their integrated report. Go to their integrated reporting page, look for the connectivity page, and you'll see this little diagram that explicitly shows the cause and effect relationships between financial variables, environmental variables, and social variables. Have you been able to do that at Carlyle? Once you own the asset, just as Jim was talking about, we see this much change in this environmental issue, this social issue has these financial outcomes. Can you do that yet?
Generally, no. What we're trying to do, and first, just to be clear, a lot of the companies we own are smaller, middle market funds. They're not publicly traded. You probably never have heard the names of most of those companies. So they have a little different incentive structure for what the value is they can get out of some of their sustainability initiatives. But what we have done in our sustainability reports is we have tried to be analytic about what we think, and that's our deal teams, is the value. So sometimes the best we can do is a quote from the deal team saying, this made a difference, because you don't have a hard number. Operational efficiency, yes, we can get hard numbers. We can see when there are new products that have come along, we can see what the revenue drivers are from those products. So either, we've had a number of companies where their fastest growing products have been products with sustainability attributes. We can quantify that and put that into the value proposition. It becomes part of the exit pitch, is we've got these fast growing, new, innovative product lines. So
and you'll capture value from that.
And I think you can capture value and exit. And so we're trying to tell those stories both internally, because some deal teams haven't seen this and others have, and you got to do some cross-selling of the ideas. And we're also trying to do it with our investors, because we do believe this adds value for investors, but we want to tell them what we think is the value in as analytical a way as we can. And it's not perfect. It's very rough, but I think that we're better than we were a couple of years ago.
Good. So let's flip to the public markets, Jerry. So when you started Parnassus, I don't think the GRI existed. Sustainability reporting wasn't common. SASB certainly didn't exist. You folks weren't providing any kind of data like this. Your belief makes plausible sense. Have you become more quantitative with this? I mean, your performance is fabulous, so there's no question about it. Have you been able to quantify these relationships more explicitly in your investment decisions?
Yes, we actually have been. Bloomberg actually has a lot of material that we use. And the sources, early on in 1984, sometimes we would go and ask companies about questions on how you treat your employees or environmental policy. And believe it or not, some would say, well, why are you asking me these questions? You should be asking me about return on investment. You should ask me about marketing. And we were really surprised. In recent years, we've never heard that. For 10 years, we haven't heard that question. So companies are more sensitive to this today than they were before. early on, we didn't really have all this analytical. So we weren't exactly flying blind, but we would just read news articles. There was no Bloomberg back then, but we would try to read news articles. We would read every article written in the business and general press about a company to see if there was environmental problems. We talked to the company, we asked them questions. So we did have a lot of information, a lot of base, but it was really through a glass darkly. And so I think that's really changed today. We have just much more information we're able to get at. We have a dedicated staff to doing that. So it's like we're just light years ahead. And it's very useful, but even in the olden days when you just had basic information, it still helped, I think, but it's much more precise today.
And Megan, so you've got all this money, right? And so you've got the resources to really dig into this.
I don't have all this money.
If you get some, can I have a little bit of it? Just a little bit, I'd appreciate that. I'm familiar with the work of G.S. Sustain. I know you've done some great work on the materiality. What kind of analytical, without giving away any secret sauce, what kind of models, analytical tools have you been able to develop at GSAM?
So the GS Sustain team is a really neat research team that's part of Goldman that's been doing exactly this research, this digging into how do we actually find these underlying factors that we can correlate with material value. And the interesting thing from their research, which has arisen, is this idea of there is a proliferation of ESG data, and all the graphs are high and to the right about how much more information there is, but how do you actually get that in a usable form? And what their most recent research found was that a lot of the ESG data that's out there is based on these binary indicators. Yes, no, I have a human rights policy or I don't. Yes, no, I have an environmental policy or I don't. And that research found that companies that actually had more ESG policies and disclosures were actually correlated with material underperformance to the tune of about 380 basis points annually. Which
So
is
there's a lot of
pretty
greenwashing.
interesting, a lot of greenwashing.
Going
And
on.
so there are different hypotheses for why that is, but I thought that was pretty interesting. And they found that the individual ESG factors that actually correlated with alpha were tied to measurable performance on specific ESG factors. The strongest correlate with alpha was diversity, as measured by number of women in your workforce. And that was correlated with about 330 basis points of outperformance on an annualized basis. They found similar alpha signals around things like waste usage, emissions intensity, et cetera. Interestingly, for waste and emissions, they found that those signals were strongest in the most material-intensive industries, which, getting to your question about correlation versus causation, I think that's an interesting data point that is pointing in the direction of causation. I think the challenge has still been that the kind of academic and the technical definition for causation, that's a pretty high bar to pass. And so I think we are continuing to find relationships, but I think it's still in the realm of investigation of saying the back tests are pretty messy and pretty loud for this, and we don't have data that goes back 20 years. And so it's harder to back test these to be able to find strong causal relationships.
So, and even given this, just a follow-up question. So most of the academic literature, it's pretty convincing on the corporate side. Some of these studies I've cited that, companies that are doing well on ESG, and there's a lag time, it's typically 6 to 7 years, all the stuff we know. It's more ambiguous on the investor side. Studies that people have done, like Rob Bauer at Maastricht, where in general it's kind of a wash, right? It doesn't look like you lose money, it doesn't look like you make more money, but there's all kinds of data problems, methodology problems. What's your sense of what the state of research is on showing superior returns on the investor side, not the corporate performance?
I think that's a really important point, and I think one of the most important lessons we've learned is to be really clear about what tool you're using, because ESG gets thrown around a lot as meaning many different things and also nothing at once. And so we're pretty clear about the difference between ESG alignment strategies and ESG integration. And so when we talk about ESG alignment, it's this idea of, it's basically passive public market investing. Old versions of this field were blunt knife, negative screens. You whack out a big portion of the investable universe that is underperformed. Alignment is the 2.0 version. It's the idea of saying, can you take an ESG data set, and now it's an engineering problem. Can you optimize a portfolio to track a given index within a defined tracking error budget? And so that looks like we work with New York State Common Retirement Fund, large public pension plan. We took $2 billion of their passive equities, benchmarked the Russell 1000, and we tilted it towards companies that were more carbon efficient per dollar of market cap relative to peers. We were able to reduce carbon emissions by 70%, but target around a 25 basis point tracking error budget. So the point there is not saying, we are guaranteeing this will outperform. It's saying, can you get that same basic index exposure? We think of that as different than saying in active management across public and private markets, how do you integrate ESG factors into your fundamental investment process where they can be material either from a risk mitigation or return standpoint? And I think having clarity around this idea of what are you trying to do is helpful. Because I think, some portfolios have been optimized for a certain ESG factor, and then, 3 years down the line, they might have outperformed. That's great, but were they designed with a kind of bent towards outperformance, or were they designed to track an index?
So one of the trends that we see as ESG investing goes more mainstream is that there was like the first-class citizens that were the portfolio managers, and then there was the second-class citizens, which were the ESG and the proxy voting people. And then you're becoming more first-class citizens, and now they're starting to merge together, right? So the portfolio managers are starting to think about what the material issues are. So I think that's a big step forward in terms of really getting to the causality thing. So this kind of mainstreaming of ESG is good. I don't think you can be more mainstreaming of ESG than when an activist hedge fund decides that they're going to pay attention to it, right? Full disclosure, I'm on their advisory board, and when I first, heard from them, I thought, oh man, But then I was like, okay, so these guys, they know how to get change. They think environmental and social issues can create value. That's about as mainstream as we can get. So I'd like, Charlie, if you could talk about kind of the theory behind the impact fund, and then in particular, how you're thinking about measuring impact, which is kind of a different angle on the measurement question.
Again, the theory is that the argument has always been to focus people on kind of the fulcrum of maximum value creation. The idea basically behind it is, as the world has continued to kind of get to be more complicated places, is a lot of companies are doing things that on a kind of quarter-to-quarter basis might make sense, but if you go a little bit out further on that kind of value creation spectrum, they don't make a lot of sense, and we want to kind of find those companies. In terms of how we'll kind of quantify that, we have a founding member of CSB on our board, another one we just hired to be who's going to run the fund with me. So we'll get a lot smarter about it. But at least I don't believe that when you're talking about things that are 5 or 10 or 15 or 20 years out, that we'll really be able to make persuasive arguments, kind of that you do this, you pull this lever, you'll get X number of peanuts that come out. I think what we're going to focus on is where you can't really deny the materiality in terms of the relevance of the thing that we're pushing to the kind of company's business model. So, where we've seen it a lot, we've done a lot of the G in the ESG kind of equation. So governance things, it's been very well established. If you've got governance red flags, that permits things like empire building CEOs and detached boards, and we've seen that. It's a pretty common theme in the world that we've played in. I think it'll be a similar type of thing. Like if you look at, again, not to harp on the Apple thing, but if you look at that company, we can't say if you make more robust, dynamic, age-appropriate parental controls that your customer satisfaction levels, which are already very high, are going to go even higher, or it'll have this specific impact on iPhone sales. But what we can say is that from a long-term business model perspective, there's not a great history with companies who make hardware that you put in your pocket. If you look at Motorola with the Razr and BlackBerry and Palm and people like that. So to the extent your business model relies on being a trusted ecosystem for people, that particularly if they're paying luxury brand prices, we'll obviously model it out the best we can, but we're really going to focus on kind of issues that they may not always go to the heart of the kind of the business model of the company, but they're going to have a direct impact on it. And we'll get smarter on how you quantify that, but I think it'll be things that kind of hit you at a gut level as directly impacting the business model.
Great, thanks. So 2 questions, Amisha, for you. The first question is kind of what are your sort of product development strategies, like where you going with your business in light of this conversation? And the second question I'm asking just so I look cool, right? Because nobody's used this term today so far, and I'm going to use it. Big data. Okay, how's that? Nice, nice. The reason I bring up big data is I know people at BlackRock who say, you know, corporate reporting isn't very good. It's probably never going to get that much better. We don't care. Big data is going to solve the problem. There's going to be all these ways we're going to go out with satellites and scrape the internet and this and that and the other thing, right? You're laughing. That's as much as I know about big data, Jerry. It's probably more than you. I'm just saying.
Touche.
Product strategies, and what's your views on big data solving the problems we're talking about on this panel?
So product strategy, I'm in the middle. I've reached out to some folks already, probably about understanding where the gaps are in data. There's probably not too much I can share at this point, but I would say just like everything with
These are all
Bloomberg.
friends.
Just like everything with Bloomberg, I would say greater transparency, but support to help you understand the financial materiality more and more as you look forward. And that's really, you know, if you think about where Mike is going, we're trying to follow that. Not sure how long and when. And that's things, but those are things I work on a daily basis, and it's quite exciting. The day I'm ready, I'll be calling many of you to say, hey, you want to check this out? Let me know you have feedback. I think from big data perspective, we've already started looking at it. For those who own a terminal, if you look at our new sentiment score, right? We already have models that say, is this sentiment good? We have it for products like, you know, is it going to do well for a stock, good or bad, based on what the history is. So they predict stock performance based on the news, and they give you a positive or negative news sentiment. We go out, surf Twitter. We look at different news feeds. So those are things that we think about. Now the question is, how does that apply in the ESG space? There are players out there that are doing this already right now, and they're trying to compete in that space. I think what's interesting about big data is the nuance of when you have multiple companies, there are different sentiments, and there are different, what does that mean? When governance is a great topic. When an activist investor comes in and is doing an activity X, how do you train a model to understand, is that a good thing? Is that a bad thing from a shareholder perspective? How do you think about the meaning of different sentences and sentiments you're picking up? I think there is work to be done there, but it's in the realm of the possible.
So you search Twitter.
I don't do it, but yes, there's a machine
There are
that
people
runs.
there. You know people. I know people.
I know people.
Who search Twitter. So let me ask you a question, because I'm the only person on the panel that doesn't have a compliance department looking over his shoulder, so I can ask this question. Probably nobody else can. Do you search the tweets that Trump takes down as well as the ones that he leaves up? Is that all data?
I would have to go ask the people who actually
You'll check with your
serve the
compliance
keeper.
department.
I'll check with my people.
You get back to me. So one last general question for the panel. We'll open it up to the audience. I hear all this talk about the SDGs, right? And I think Tansi said, you know, the business community sees this $12 trillion opportunity. The investment community seems to be anchoring on it more than the business community for the most part. There's a lot of them. There's a lot of targets. I've done this mapping down to the industry level, 79 industries, the CSB material issues, to the target level of the SDGs, the theory being the material things are what investors care about, and so those will do good things in the world. In terms of your investment strategies and the tools that you're building, like how are you folks thinking about the SDGs?
Why don't we tell the audience what SDG means?
Like TCFD. I did, well, never mind. The Sustainable Development Goals, the 17 Sustainable Development Goals. Thank
All
you.
right, so we're all on the same page now. I think the Sustainable Development Goals are important, and we don't use them as a checklist, but it kind of it gives us. We've been using some of those anyhow. We just didn't call them SDGs or any other of the three-letter words, but we think they are important. In fact, when we've read them over, and it informs us how we ask the questions or how we ask the staff to do that. So I think it's important that it comes in, and I think really it's a systematic way of covering these things. And some are more important than others. We try to focus on the important ones first. But yes, the answer is yeah, we do think it's very useful.
Great. Megan?
We've seen a pretty huge inflow of questions and inquiries and interest from our investors globally. I'd say much more so from institutions, particularly in Europe and Asia. In the US, we've seen less interest, particularly in the high net worth channel or kind of foundations and endowments. What I think is really interesting is I think they're a great unifying framework for how institutions can think about ESG issues across their portfolio. Instead of ESG being this big field of many, many different things to pick from, it's a set of globally agreed upon priorities for environmental and social issues. I think the challenge is that the Sustainable Development Goals were created as a global plan for sustainable development. They weren't created as an investment thesis. And they are goals that need policy, they need philanthropy, they need investment dollars, but they are not purely an investment thesis. And so I think one thing we focused on is saying, take private markets, for example. We think the SDGs, many of them align with really interesting investment themes around healthcare, around education, around resource efficiency. So how do you take those investment themes that you think have strong drivers of growth and profitability, but convergent business models that can generate measurable environmental and social impacts? How do you still maintain the same investment focus when you're investing in those themes, but then use the SDGs as a way of reporting out what those impacts looked like? Because you can use that as a framework of talking with other investors, working with policymakers, governments, et cetera, to make sure that the SDGs are being addressed. But I think we've been focused on them more as how do you use them appropriately across your investment portfolio, where they can be useful and core to how you think about the impacts that you're generating.
So since you've got a lot of money that you're going to get your hands on, give me some. I'm going to give you some competitive intelligence.
Okay.
This morning, I got from Morgan Stanley's research department, maybe you know about this, basically their first report on the SDGs and poverty. And it was very interesting because it was this very thoughtful analysis, and they've listed about 110 companies that they see what their business models are to support it, and I assume they're going to work through the rest. So I think, when the big banks and the big asset managers start digging into that, it starts to make it real and tangible. Jackie?
Yeah, I would say we're further away from that in private equity, maybe because we have smaller companies. They're typically a lot of B2B sales. But when we think about, we work for our investors. Our investors are large pension funds, and it's not clear yet where the SDGs are going in terms of being a driver, although we will see investment themes. I think there's the same kind of idea. So if you talk to our deal teams, most of them will not have heard of the SDGs. They will have heard of SASB, and those are very concrete and sector specific and seem important both to de-risk and create value for their investors. So I think people will be much more familiar and will be using those. The one exception is in telecom and media because of the competitive dynamics there and the race to the top dynamic that you see where there's just, if you're not reporting against the SDGs, then you're behind your sector. So you really have to do that. And companies in that sector that we own are reporting against the SDGs, and those deal teams will be more familiar with them.
Great, thanks. Charlie?
Yeah, so the SDGs, obviously we've looked at them. I think that some are more relevant for public company investors than others, obviously. I think that to the extent that we directly key off of them, we would try to do the same thing we've done even just with the more basic concept of ESG, which is translate each one into kind of a shareholder value proposition. So for the G in ESG, does the board work for shareholders or do shareholders work for the board, as a way to as one of my colleagues put it, to boil it down. Or for the S, again, as my colleague put it, is the company's business model predicated on giving customers a good deal or not? So making them very kind of translating them into kind of shareholder value creation concerns. Not because we think that the concerns of shareholders should define the universe of things that people in the world should care about, but to the extent that we can bring something new to this, which is to try to show companies that their shareholders do care about these things, particularly some of the more kind of long-term goals that kind of embodied by the SDGs. We'll certainly work on them, but I think it's going to be part of a broader framework for us of shareholder value creation.
Great, thanks. Amisha?
We get a lot of questions. I think PRI did a great job at the last session in Berlin, where they just brought up the topic of SDG. And I think for 3 to 4 months after that, every client call I answered had some mention of what is your SDG product, or how do I identify SDG? I'm trying to create a fund. How do I do this? One of my biggest fears as I have many of these conversations is even a large pension fund wanted to analyze it. You're looking at segment revenue. So let's say you're in the food and beverage business. Just because you sell food, does that now make you check the box on ending food hunger? And it's quite, there are moments where, can you give me their segment revenue? And which geography does this come from? And as I had that conversation, I'm like, I don't think that was the purpose. And I think I think the investment community, if we get ahead of ourselves on this without proper frameworks to quantify what we are trying to say, or call it thematic investment like you did, I think we run risk of just greenwashing, and I think SDGs pose a lot of that risk.
Great, thanks. So it's 4:45. We're at a fork in the road. We can leave early for cocktails, or we can take questions from the audience. You choose. Okay, I see where we're going with this one. Yes, sir.
Hi, thank you. Alexander Golding. I was curious about, Jackie, specifically for you, you mentioned that you use CSB as a framework to evaluate private companies. I was wondering why you use CSB and not another, the IRIS framework, which has just so detailed. So
Yeah, I mean, it was combining what is the most practical tool that our deal teams and our companies think is reasonable, so we get good information around those metrics. And honestly, 8 to 10 metrics is a sweet spot. I was involved in GRI in the early days, and that's now up to over 100 metrics, and that's just not going to be commercially as impactful. So it was, going for the 80-20 rule. I think we get it. I think that helps us get to the right place 80+% of the time. And everybody likes it. Our deal teams say, yes, I can work with this. There's a 2-page table I can look at, and then if I have a question about a metric, I can get more information. But the starting place is very clear and very commercial and practical.
Thank you.
Great. Yes, ma'am.
This could be a question for you, actually.
I'm the moderator.
What do you think the obstacles to more 401ks adopting ESG criteria and the evolution of that? How do you see the evolution?
It's a great question. I think it's, so the question was the obstacles to 401k plans doing more in the way of ESG integration. I think there's 2 elements of that. There's an ideological component and there's a legal component. And I think the 2 things get confounded. In the survey that State Street did, among fairly sophisticated investors, the fiduciary duty thing has fallen away. Right? It used to be that you're violating your fiduciary duty. It's a transfer payment. It's philanthropy. Blah 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 blah. Most FAs still think sustainable investing is philanthropy. The interpretive release from ERISA changed things dramatically here. General counsel still want to be conservative about it. You can still count on one hand the number of corporate pension funds in this country that have signed on to the PRI. Makes me laugh. The CEOs complain about the investors not giving them credit for ESG. They run their pension funds, just like the ones that they complain about. Unilever's U.S. pension plan, Paul Pullman, they were a signatory to the PRI. So I think it's just really a question of courage and will. Lee, do you want to weigh in on that?
I was just going to say so is Bloomberg. And we do have the Parasmus sustainable plan in our 401k. So we did become PRI signatories.
But it's a good question, and I think it's one of those things where, particularly in the United States, getting the corporate pension plans to move in this direction would be a big deal. And there's some initiatives that people are working on that. Yes, in the back.
Hi, Steve Jody, NYU Stern. When we do the course here, we sort of say, first there was kind of social responsible investment, we screened things out, and we moved into positive ESG, and ultimately we're moving to impact, and we're kind of moving in this rational frame, for this rational ideal. But the last couple of weeks, it seems like the most that ESG has been talked about in the papers are all about how do we get guns out of our portfolios? How do we align our values with things? And that is, I think, what Megan sort of used as like a blunt instrument, this first level, screening out. Where do you all see that as people try to align their individual values with what they own in their portfolios? Is that relevant? How does that play out in what you're seeing in your products?
It's a good question. It kind of gets to this value versus values thing, right? Who wants to take that, to kick it off?
Well, this is kind of it's not a direct response, but one of our founders, David Rubenstein, talked today about the fact that we've never invested in guns or tobacco. He and the other founders never believed in it. They never wanted to be there. At the time they made that decision, it would have been hard to make the financial case for that. But we're now today, and we've had, I can't tell you how many of our investors calling to make sure they're not invested. And the fact that we can say to all of them, no, you're not invested in, even in, retailers that sell guns, which is and the next time we have a conversation about something that is a social ill or even borderline social ill, it'll make it easier to win the argument. Do we need to invest in this space? Will it hurt our reputation? And what are the benefits of maintaining a good reputation? And it gets tested in this kind of situation. So I think the reputational impacts that get seen when you have an incident are very important to give people the backbone to make the decisions they want to make, because then they can point to something that would have been risky, would have hurt us if we'd had to say to investors, yeah, sorry, you're actually 10% in companies that own guns. This would have been a nightmare for us right now.
Anybody else want to weigh in on this?
So I look at it from, if you look at the GSIA numbers about what is the market for sustainable investing, and it's $23 trillion at the end of 2015. Majority of it is still exclusionary screens. So we can talk about where the market is headed, but exclusionary screen does drive a lot of decisions, and almost everyone has something, right? Carbon, climate. So you can put or if you're using scores, people are eliminating the bottom. So ESG integration, if you look at it, is still an evolving field and not well defined, versus I think exclusionary is something that's well defined and almost everyone has in their portfolio.
Charlie?
Yeah, but obviously exclusionary investing is great, but I don't want to sound negative, but I think that the gun companies are, I think, one of the areas where you see the limits of what investors can do, and you still need a healthy and functioning political system for issues that are so big. And some people, not to get political, would argue we don't really have one right now. So this is not one where I'm at least holding out hope. I mean, if you look at how have things changed in the past, 6 years since Sandy Hook, or 2 years since Orlando, or I think that there's just too many actors here. It's unfortunately become politicized. I find it very difficult to believe that.
And some of the biggest and most progressive pension funds are not going there.
Actually, can I add something
Sure.
to my point? And countering the values versus value, I don't think it's an either or, right? Because if you look at Dick's Sporting Good, and if I here the gunman bought a handgun from their store, and hence they could have turned that political nightmare by doing a right PR move and saying, we've probably thought about it. Their CSR team or any lawyers may have thought about what is the impact of gun, and they turn it around to say, we are banning any rifles or selling any gun ammunition to anyone under 21. So they took that PR piece that could have been a negative PR into a positive PR. So if you put on the corporate lens on, there was some positive value to it, potentially. So can you still think of it as just ignoring any ethics around or personal beliefs around that topic? Can you still look at it as a decision that's a business decision?
Fair enough. So I think we've got time for maybe a couple more questions. Is there any? Yes, sir.
Hi. So factor investing. It's sort of one of the big things that's out there in the world today. And so I guess my question is, I'm going to take G off the table, but in environmental and social issues, do you see anything bubbling up to the point where the investment world would say, here's a factor that I can actually use to drive an investment thesis? And going one step further, could you even see a scenario where there's a factor, what factor might you see, that could actually even be a long-short strategy around a factor? but where is there sort of confidence, belief, sort of potential around a factor or a strategy?
Do you want to take that since you got Jim?
Yeah, so we've been doing a ton of research around that in our quantitative equities group. And I don't think ESG or components of ESG have bubbled up to the level of a value factor, a momentum, or a growth factor yet, but I think that's still on the table. What we have found are really interesting alpha signals. And a lot of those we've taken and already embedded into our quant equity models because you want any alpha signal. And so the idea is, can you find data that is material that hasn't been priced in yet? And that will change over time as things get priced in. We were talking about, one of the interesting things about an activist hedge fund is, as people get better about ESG, companies adapt these behaviors, those things get priced in. And so how do you still find inefficiencies? And so we found some neat alpha signals, for example, using natural language processing. So we use our big data capabilities and scrape all of the public kind of websites and news media, and I found that companies that have more ESG terms associated with them are outperforming right now. And it could be because consumers are increasingly valuing sustainability traits in their products, et cetera. This idea being, can you use these data resources to find things that are material, that can generate alpha, but recognize that those might change over time as markets adapt?
Anybody else want to jump in on this before I get to the last question? Anybody else on that? I mean, it sounded like a finance question, and I'm a PhD in sociology, so I'm glad you answered that one. It's like, don't ask me. Yes, sir, last question.
Yeah, Steve Rockman with Iowa Sustainability and also with Project ROI. And a quick comment into a question. One is a research that we've done have shown that actually the companies rated at ESG leaders tend to do better in the market. Second best tend to be the ones that are Neanderthals that don't believe in it. And the last place are the ones that are doing box checking. So going back, Megan, and what you were talking about, and Jackie, a little bit from you, can you talk a little bit more about what would be those 8 to 10 data points that you think would distinguish the box checkers from the ones that are taking this seriously, beyond those that are with SASB?
Yeah, I mean, I think this is a place where having some expertise in the space is very important. And it's one of those things you know it when you see it. So I can look at what one of our, what's in the data room of a company, and by the language they use, what they're focused on, what initiatives they're promoting, I can tell how much greenwashing's there because I've been doing this for 25 years. And I just sort of, can give the team a sense of what I see that concerns me, what I see that makes me think this company really doesn't know what they're doing. They're checking the box. And I don't know how you can do that other than have seen so many companies and really looked at the ones doing a good job and the ones not doing such a good job. And I started out as a chemical engineer with the EPA, so I've been really looking at it from the ground up to be able to really figure out those nuances. And I think the best analysts out there, and once we get really great analysts looking at this aspect of companies, will also be able to do it. I mean, you bring professional tools and professional experiences to differentiate between who's greenwashing and who isn't.
Anybody else want to jump in on this? Well, make up your mind.
I would say if you look at just policy checkboxing, and I think that's to Megan's point, it's important to know if it's even the topic is in the company's radar, but if you're not looking at the quantitative performance, the trends in that performance, or the targets relative to where they started, and comparing that, I find that there's a lot of assumptions built. Like whenever you look at scores, there's an analyst who's trying to do your job and is just saying, oh, I think this policy is a good policy and I'm going to give this company a high score. And I think staying away from that approach is probably one thing to consider as you look at the data.
So Tansi told me they're a little, do you want to weigh in? No? You want to leave? You got to go? Goodbye. Thanks. Your support.
But if you have SASB standards for a sector and you have, a set of KPIs, you can compare.
She's had enough.
So I think that also, you have to have data somewhere as well. But
So Tansi told me they're slow setting up the cocktail party, so we've got time for one more question. One more question. One more. Since you've been standing up.
Yeah, this is Chris Fowl from the PRI. It's really just a comment back to the DC question earlier, whether 401k plans are making a move or not. We just did a webinar 2 weeks ago, which would be a good resource for maybe corporates in the room, for SEBA, the industry association focused on corporate pension plans.
1 hour on our YouTube channel, the PRI YouTube channel, that talks about this movement and the potential for it going forward in the U.S. So please take a look at this.
Give a link and get it to people. Yeah, that's great. If you get it to Tansi, she can get
You get me the link, I'll spit it out. Yeah, thanks, Chris.
Tansi, over to you.
Okay, thank you for our terrific.
Thank you.